The market was fairly mixed across the board yesterday, and if we look at Pepsi, which is under the spotlight today, they were up, nothing special, just over 1%. But as we've said many times, year to date, companies are looking strong for the large part, posting double-digit returns so far. Unfortunately, PepsiCo isn't one of those that comes in that category. 2025, they are down around 11%. Now, to make things interesting, they have just reported their earnings, as we can see, alongside some other notable companies. And as we always say, earnings season does bring lots of volatility. If there are any companies you want us to cover, do let us know below and we will get to them. But as a quick spoiler alert, before we do a deeper dive, revenue for the company is up, but one of the issues that we are seeing with them, which we're going to get to into quite some detail, is that volume is dropping. What this means, customers are buying less products, which is what we will go on to explain as a red flag indicator. Now, the market does like these earnings overall. We see it in the pre-market up around 3%, but it's been battered not just year to date as we highlighted, but over the last 12 months, they're down 18%. And over the last 10 years, if you have been a longer term shareholder, you'd be up only 41%. Now that is a massive underperformance of the S&P, as we'll go on to highlight, and even if we were to incorporate dividends reinvested, the result would still be the same. We'd still notice underperformance. Now, even with the gain that we're seeing in the pre-market, they're still trading towards the lower end of the 52-week range. We can highlight their 52-week highs around $180 mark, and whilst historically, at least in 2025, all three analysts were calling this company a hold, we do now see Seeking Alpha switching to a buy, although fairly weak, 3.61 out of 5. But just before we get into the earnings themselves, we want to spend 1 minute just covering the valuation, because based on their historical average forward P of 24, it does look to be severely undervalued, sitting at 17. But remember, this is something we just look in isolation, so it doesn't determine whether we buy or sell. Yield also showing undervaluation, currently offering 4.2% to investors when the average has sat at 2.9, but something that's also important to understand, can they continue to offer this high of a dividend? Something we'll look at in terms of the safety as well as the free cash flow payout. Again, conclusion does remain to be consistent here. We are seeing disparity from where the company trades at and the bottom end of the blue tunnel, so another severe undervaluation. Remember, the blue tunnel does show within the parameters of itself expected intrinsic price, and if we were to zoom out over the last 5 years, we actually noticed from the beginning of 2024, this company has been trading more and more undervalued as time has gone on. But if we look from 2020 to 2023, this was a company that for the large part was trading in a reasonable signal. And if you're interested to note, against the sector median of 16.3, PepsiCo is trading at a very marginal premium of 5%. But as we've said, against their own historical, you are getting quite a substantial 26% discount. Now let's dive into their earnings. As we can see, they did perform a double beat, very nice. And on top of that, we do get to see their full year outlook has been reconfirmed. That could be a worry if we did see that narrow lower or be completely suspended, but even as it's cited here, demand falling, the company has maintained fairly strong performance. Now, in terms of the actual numbers, EPS 212 with the expectation of 203, so fairly substantial beat. And the revenue, we do get another strong performance, 22.73 versus 22.27. Now, while we do get to see a double beat, it is also important to drill down into the numbers, see whether or not we're seeing any kind of growth. Now, sales up just 1% from the same quarter last year, tells us quite a lot of things. We already alluded to it earlier in terms of volume decline, but now when we incorporate inflation, which has historically been around 4%, their real top line is in fact decreasing, as we only note 1%. We also see worldwide volume falling 1.5% for their food, and pretty much noting here flat for their drinks. This isn't great. This has also stripped out any FX changes. So as we've highlighted, whether or not you want to include inflation, that is something to consider. But consumers are buying less products, whether they're just buying less of PepsiCo in general or they're moving out to cheaper alternatives. Conclusion is still the same, and it's not looking good for the company. We can also see the PepsiCo drink segment in particular, that volume was down around 2%, and we're going to highlight shortly, this is a trend we have now been seeing for quite some time, and one area where in fact they're actually seeing strong growth is in Pepsi Zero Sugar, where they're noticing double digit, and that's probably quite a good gauge of where the trend is currently at. Consumers, whilst they're buying less PepsiCo products, they're also more health conscious. We also get a segment here about management, how they're trying to cut costs, improve their margin. In fact, they've closed down 2 of their manufacturing plants. And in all honesty, whilst they say this is trying to make transportation logistics more efficient, it isn't typically a good sign to see any company closing down manufacturing plants. Could be a bit of a gauge that management do believe longer term they could see this trend of volume continue to decrease. And we just want to take you back to their last earnings as well. This is something that management had already foreseen. They brought the argument that tariffs would have a dampener on the numbers, and that is something we are starting to see. Whether consumer confidence is directly related to that or an overall trend is something just to think about. And we thought it would be useful just to consider what Nestle did when their volumes were decreasing. Now you have to understand from a business perspective, if volumes are decreasing, the one way that you can help increase your revenue is by increasing prices, but then you have to consider price elasticity. Will consumers continue to buy your products if you increase the prices? And we have an example here of Nestle where it says they went too far by increasing the prices of their products, and ultimately customers did turn away. So this is why we would say there is a bit of a worry around PepsiCo right now. Yes, great, we saw a double beat. Yes, great, they reiterated their outlook, but volume decline is a worry. And again, we saw this in the last quarter, revenue slips on their volume drop. Now this was in particular to some of their brands, Frito-Lay and Quaker, but as we've just highlighted earlier, we're also seeing this quarter drinks show no growth at all, and in fact continuation of snacks on a downward trend, down 1.5%. And we also see from a few months ago where it now is consideration of PepsiCo and their management where they have to completely shift their snacking landscape. While this is under the spotlight and for good reason, as we're seeing the continuation of a downward trend, it's probably also something they should consider about their drinks as well, which was flat for the quarter, as ultimately consumers not only more conscious about how much they're spending, but also in terms of health, as we highlighted, double-digit growth for their zero sugar products. And it's never good when you hear about a company looking to save itself, and this is in relation to years of decline. We can see it, their number 1 drink product falling down to number 3, and management are saying that they believe now they have potentially lost the focus, something they want to bring back straight to the forefront. And one way they are doing that is by acquiring brands. We see here they paid just under $2 billion for Poppy. Hopefully this is something we can see help aid some of the revenue drop, at least over the last few quarters. And we'll highlight it's not just this quarter where revenue is up marginally at 1%. Year to date actually is pretty much flat, negative 0.3%. And we also see earnings per share down 59% from the same quarter last year. Now granted, we are seeing some impacts on foreign exchange, but the main conclusion is still the same whether you strip that out. Volumes are declining, the business is not looking as strong as it once was, as we'll highlight through the historical growth. And the next 3 quarters, yes, they do anticipate growth, but we can see for Q3 and Q4 to close out 2025, we are talking about low single digit. Now, in terms of their next full accounting period, December 2026, forward P is estimated to drop even further to 16.2. So the question may now be, yes, this company doesn't look like it has the best future in terms of growth, but are we now looking at a value play? Is this too cheap to ignore? Now, the institutions themselves, with the 73% ownership, they sold $11 billion worth, in fact, over the last year. Same time frame, pretty much buying twice as much. And we also noticed in the most recent quarter, 613 million buys versus 489 million selling. So at least in the large part, institutions are still continuing with buying more than selling. Not something we can say about super investors, at least looking at the most recent quarter. 9 in fact hold this company within their own portfolio, and in the most recent portfolio composition changes, we can see Terry Smith of fund Smith, very famous, fully selling out, in fact a 100 position removed, and that equated to just under 4% of the portfolio. We have others who have in fact trimmed. We have someone else, Robert Ornstein, who did add around 21,000 shares. Now, not only was that very small in terms of the overall change to the portfolio, but we can see against those that have sold, the net position by super investors is quite a significant sell. Now, we've already highlighted growth, but I think it's always good to look at it against the sector as well as their 5-year average. Now, year on year, pretty much flat. Forward looking, 1%. As we've said, that's not even anywhere near enough for inflation, so real terms it's decreasing. It's also not only lower than the sector, but important to drive out that over the last 5 years, this company was growing fairly decently for the industry, around the 6 to 7% point, and in terms of earnings per share, not looking good over the next 3 to 5 years. 3 to 4% is what is projected. Now again, that comes below the sector at 6 and their own historical of 7, but the tune is slightly more positive when we look at the profitability. It comes in at an A+, now gross margin 55%, above the sector at 36, slightly above their 5-year as well. Bottom line, 10%, well above the sector and pretty much in line with their own historicals. They do also continue to generate more and more cash from operations, 12.6 billion in the last year. That is above their historical of 11.6 and well above the sector at under 1 billion. Now, we talked about this dividend because it is quite an important part of the company, maybe one that is making you consider buying, and the safety score sits at 93, as we will get onto shortly. We've covered these two severe undervaluation signals. Remember though, we need to have an investment thesis before buying a company. We shouldn't just buy solely on valuation, and they did increase the dividend just this year in February at 5%. Nice to see above 4% inflation. We can also see the dividend safety score was reaffirmed a few months ago, and ultimately what very safe means is that a dividend cut for this company is highly unlikely. Also, for those that believe we're heading into a recession or we're in one or there's one upcoming, in the 07-09 Great Recession, they actually increased the dividend. They pretty much had flat sales, which was actually positive given the average of the S&P sat at -12 and the return itself -35 above the S&P's -55. Now, overall, dividend growth has been fairly attractive, around the 7 to 8% year on year over the last 10. And one thing that investors will like to see is that they are a dividend king, fairly recent one at that, with 52 years of consecutively increasing it. Now on to one of the worries I have for this company. As I said, investors may be drawn to the very nice and attractive yield. It is also a dividend king, but free cash flow, and as always, we do focus your attention on the earnings, which is susceptible to manipulation by management through accounting. We want below 70% for the industry. Now, this is what we would call a red flag indicator in 2024, 102%. Anything 100 above, essentially telling us management are paying more in dividends than they're generating in free cash flow. Not something we like. We also noted this in 2022, also sit on a trailing 12 month. And whilst the expectation is to drop down to 76 over the next 12 months, in reality, we've seen this for quite some time now, and it's not come to fruition. Definitely, as we would say, something to bear in mind. Red flag indicators aren't necessarily something you want to see for companies you're considering, and probably no surprise to see given the growth. Free cash flow per share, whilst we like to see consistent growth year on year, it is looking fairly flat, some years quite a significant drop. Now, expectation is growth over the next 12, but question is this something you believe management can execute on? Then we get the sales growth, where as we highlighted, minimum really 3 to 4 just to keep up in line with inflation. We're seeing 0% in 2024, potentially a decrease in 2025, and the highest it has been 13% in 2021. Otherwise, nothing too great here to discuss or really champion the company for. And then we move on to the total sales on a numerical basis. Now, they have grown 50% over the last 10 years. You will notice, though, quite a slowdown in the last few years. And we always love companies that return excess cash to investor pockets through share buybacks. They've done it, but very slow. In fact, over the last few years, this has been non-existent. Then we get to the return on invested capital, ROIC, 12% or more. Great to see the consistency year on year, sitting at 16%. Remember, it gives us faith management are able to effectively allocate their capital. Margins also looking good and consistent. In fact, when we compared it to the sector overall, very, very strong. Free cash flow also no worries at all, above the minimum 5%. Then we get to the net debt to EBITDA, which also correlates to the dividend safety above, but more importantly, the balance sheet strength. And we want to see here below 4 for the industry. Numbers you see below, number of years it would take them to pay off all of their debt net of cash on hand. 2.1 on a trailing 12 month, expected to go a little bit lower over the next year. So not the worst, not the best, something we would say just to keep your eye on. Now we also want to see how has this company historically done against the S&P, including reinvesting the dividend. We'll also incorporate the QQQ, even though perhaps it is slightly a different company to really fit in, but more comparisons the better. And we can see down 15% over the last year. Both S&P and the QQQ are up double digit. We expand over the last 5 years. Again, we can see such a difference across the ETFs against Pepsi. And over the last 10 years, conclusion remains to be the same. You would have been better off invested in an ETF than PepsiCo. Something perhaps worth considering. Yes, past performance is an indicator of the future, but it is looking unlikely that they will be able to outperform moving forwards. But you could also argue this is a company that perhaps is more attracted to by income investors. And as always, we'll compare them against others in the sector, similar size. We have Coca-Cola as well, so we can understand the issues the companies face. Is it isolated to them or the sector? And they're the only ones that are down over the last year. We do also get FMX, but when we compare it to CCEP, Keurig, Dr. Pepper, Monster Energy, Coca-Cola, they are all in fact up nearly double digit. Now when we zoom out to the last 5 years, they are the worst performing, quite a difference between Coca-Cola as well, which is up 75, and even over the last 10 years, as we've highlighted, it's underperformed the S&P, but it's also one of the worst performing against others. Coca-Cola also outperformance. Doesn't mean this will be the trend moving forwards, but always good to see past performance as one layer of our overall thesis. And whilst we've already highlighted the revenue growth over the last 10 years, it hasn't been massive. We're talking around 50% from 2015 to 2024. It's always good to see, do we notice that 50% growth on their bottom line net income? And actually, for the large part, yes, although again, very inconsistent, going from around 5.5 billion in 2015 to now sitting just under 10. And the other thing is a quick health check, total cash versus total debt. We notice it's been decreasing over the period, 12 billion, now sitting at just under 9. Doesn't tell us anything, just looking at one number, so we do compare it to total debt numerically and directionally. And what we actually get to see, whilst cash has been decreasing, their total debt has been increasing. 34 billion, now sitting at 49. Doesn't necessarily mean there's something wrong with the company, but this adds to the issues we spoke earlier about the dividend safety, free cash flow payout above 100%, net debt to EBITDA around the 2 mark, all considerations for whether or not you believe this is an undervalued buy. Now, before we jump into our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to get access to severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, updated intrinsic value based on this earnings comes to $151, the average of the three. Now we're going to run through each one. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, PepsiCo or not. But based on the multiples valuation, companies in a similar sector and size, average P multiplied by the EPS of PepsiCo, we get our first undervaluation signal. Remember, we're not looking at any one of these models in pure isolation. We then have the dividend discount model, most recent increase 4.8, on average 6.81. Now we have gone a lot more conservative at 4.75, in line with the most recent increase, to get our second undervaluation signal. We then move on to the discounted cash flow model, where we have the free cash flow year on year. Average sits at 0. Now we have gone 7% moving forwards. Up to you whether you consider this to be conservative, optimistic or reasonable. But then we get the discount rate and the present value of these future free cash flows. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 114. over valuation. Again, if you grab a copy of this model, you can always play around with these inputs to decide on what you believe. If you want 10%, if you want 2%, intrinsic price will move. So we've gone with 7%, and what we do notice here is that we are getting an undervaluation signal given the current price sits at 139. Now we don't stop there because we want to use a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $136, $137, not far off where the company sits now. So it really depends whether that is sufficient for you. Dividend King, a yield at 4% to buy or maybe hold. But as we said, there are a lot of red flag indicators for us, and this isn't one we would consider. Declining volume that doesn't seem to be moving in the right direction anytime soon. Now, whilst the dividend does look to be safe, as we've covered, that payout ratio has been very high and for quite some time. That is a bit of an alarming signal, and margin of safety just isn't sufficient. Now, if you wanted 20%, buy at 121, at 25, 114. At the moment, though, as we've said, just about a 10%. Wall Street, they continue to revise their price targets, so don't be surprised when these do continue change. At the moment, 147, 6% upside. Give us your thoughts. PepsiCo overall, a buy, hold, or even avoid. Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.